Resume session. Thanks.
Okay. The question is, how do you get current volume? The only current volume you have is tick volume, but that's valid. You can use that as current volume. No. The question is, where do you get the volume? You get the actual volume the following day, but you get tick volume online every minute, tick by tick. So, the fractal, Bill Cruz at Omega Research. We were just talking about how you can color the squat bars and the green bars and all this sort of thing. And when you look at them, you can really, and Darla has them out there on the station. Go take a look at them, because you can really then see how ends of trends end with a squat in one of the three top or three bottom bars. Okay, so you have a fractal, and the fractal is a very sloppy definition. That's a fractal up, where you see that caret. That one is 5 bars. It's a fractal up. It's also a fractal down. Fractals can share bars right here and right here. Now, I am, we're starting out the second hour, and I know enough about psychology and physiology to know what's happening. You went out for lunch. Some of you had meat for lunch. Some of you had, how many of you had red meat for lunch? Okay, hamburgers, this sort of thing. Okay, red meat is very difficult to digest, and the first order of business for your body is to get that red meat digested. The first order of business for your body, maybe not your mind, but your body, is not to listen to what a fractal is, but it's to get rid of that meat down there. And if it's going to take a lot of blood and stuff to get rid of that meat, where do you think it's going to come from? Gravity, right up in here, and when it gets down there, the eyes get closed and this sort of thing. Now, we're going to do two things here. We're going to add a little bit of culture to this thing. This is a crass, money-making kind of a group we are. So we're going to add a little culture, and we're going to add a little poetry here. I can't sing, so all we can do is poetry. And the poetry goes like this. Oh, I say, have you heard about Harry the trader? He just got back from the floor where he was needed to trade the bellies. Everybody knows about Harry. Hip, hip, hooray. I'm going to ask you to do two things. I'm going to ask you to repeat after me when I say this, and in the peripheral vision of your eyes, look at the guy or the gal next to you on both sides. If they do it well, you tell us, and we'll let them come up here and do it solo. So, everybody stand up. Push your chair back, put your pencils down, and stand up for just a minute. Because this next hour, we're going to share some important kind of stuff that will make money for you. And what I'm going to ask you to do is to do what I do, because we also know from psychology that if you put something into it, you're going to get a lot more out of it. So we want to put some gestures in there and say what I say after I say it. So put your fingers up and put them around this way and say, oh, I say. Have you eared about Harry the trader? He just got back from the floor where he was needed to trade the bellies. Everybody knows about Harry. Hip, hip, hooray. Okay, sit down. Now, that was more for my benefit than yours, but I hope you get it. So, what you have is you have a fractal up here, which is a minimum of 5 bars. Yes, that's a secret signal. That's the secret lodge here, and this is the handshake. Then that's followed by a fractal in the opposite direction. What you have between the opposing fractals, a fractal in one direction followed by a fractal in the other direction, is always, 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 always an Elliott wave of one degree or another. The underlying structure of the market is the Elliott wave. The underlying structure of the Elliott wave is the fractal. So it's like the riverbed on the river. It's the fractal that the market uses to get going. So the question comes up, how do you trade a fractal? Well, basically, if you're going to out trade, all you do is you let the fractal form, and this is on page 18 for those who are listening on tape. You let the fractal form at A, and when you get these 5 bars, you have the fractal form. The market comes down, and it goes up to B, and you buy at B. That's a breakout. Now, what that will absolutely, absolutely guarantee you is that you're never, ever, ever going to be left out of a trend. And if you go back to the charts that Russell and Linda looked at this morning, and look at that dollar a day up in Canadian dollars when the elections were happening, you were already in that trend 4 different places long. And we'll find in most gaps is that you'll have a fractal before the gap. So if you just trade the fractals, 90% of the time you're going to be on the side of the gap before the gap ever happens. In the last 6.5 years, the only time that and the worst trading we have done and I personally, in the last 6.5 years was last October and November. And if you remember, when that crop report came out, when everything was up limit, anybody remember that? We were short everything. But that's the only time we've ever had in the last 6.5 years a limit move that a fractal did not get us in before the limit move happened. Every other limit move that we've traded, we were in before the limit move. So we don't mind that much. That one time in 6.5 years is okay. All right, over to page 19. And anytime you have a fractal in one direction followed by a fractal in the other direction, the first fractal becomes the start. The second fractal will become the signal. And I think we need to go one more page. I think we need to go over to page 20. Yes, we do. So on page 20, you have a start here, and you have a signal there. So if it comes down below that, you want to be short. The market's telling you that the riverbed, the underlying structure is short, it's going short, and you want to be short. Then the next question comes up, well, if it's going short, how do you get out? If you're in a trend, the bait to stay in that trend and not get out, and we'll show you some actual charts in a moment, and we'll show you some charts. Before we leave, we'll show you some charts that, we'll show you some charts of what's happened in the last couple of days and what we think is going to happen come Monday. Your stop is the furthest away of the last two fractals back in the opposite direction. So here's your start at 21A. You came down here, went back up another, and then you go short here. Your stop would be two fractals back. Sometimes, and especially a lot in the 5-minute S&P, the second fractal back will be closer to your signal than the first fractal back. If it is, you would put your stop at the furthest away of the last two fractals in the opposite direction. Any questions about that? In the opposite direction is very, very important. Okay? Then there is a question of leverage on a signal. And let's say that you had, this is on page 22. At the top of the page, you have a golf club. If you're a golfer, let's say you're in a golf tournament, and this is a weird kind of golf tournament, because every drive you make, they saw 6 inches off your handle. So you get about the 8th or 9th hole, and you've got a very, very short handle there. Your leverage is gone. What makes that little round ball that's so frustrating to some of us is that we chase around the country all the time. Go is your swing, your strength, and your leverage, right? If you take one of those away, any one of the three, you're going to hurt your production. If you take the leverage away, you're going to hurt what's happening. In the market, as the market moves from up to down and down to up, once you have a fractal form, it's always a fractal, but it changes its personality depending on what the market's doing. So it can be a stop, a start, or a signal. And the stop is always two fractals back in the opposite direction. But what will destroy a signal is the same thing as sewing off your golf club. So let's say you have a start up here. We're at 22B, at point B on page 22. We have a start. We come down here. These bottom 5 bars form a fractal. So we have so if the market turns around and comes down, we'll be short. But if the market goes back and one tick, which means 1/4 cent in the agricultural or some of the agriculturals, then that cancels that signal. So if the market then comes back down here, it would not be a sell at this point. So that's the leverage. Any questions about that? It's a very simple concept, but a completely important one. Okay, let's then look at some actual samples. Let's look at page 26. And by the way, everything we're going to talk about here are actual trades. I don't believe in hypothetical paper trading, this sort of thing. I think it's good but if you think paper trading is the same as trading in the market, you're in for a rude supply. This is the things last year, and this is just absolutely straight, plain, vanilla fractal trading. That's all. So where you see down here where we went long at 628 on about the 29th of June, the fractal is over here to the left. Can all of you see that back there? So we went long here at 628 off of that fractal here. There's a fractal up here. We went long here at 661 at that. There was a fractal formed here, and the next open limit, not limit up, but it opened gap up here at about 685, actually 6, and we were filled on the gap. But the fractal was formed the day before. And these are 60-minute charts. I like trading a 60-minute chart because one of the things that I have done, I I went for decades where I never ate lunch except in front of the monitor. I never saw the dining room or the breakfast room anytime during a trading day when the market was open. A couple of years ago, Ellen, my wife, and I made a New Year's resolution. I was going to get away from the market at least an hour while it's trading. And for me, trading a 5-minute S&P bar chart and getting away for an hour and a half to go swimming or running or go to the gym or something was heresy. But I found an interesting thing happen, and that was that the more I stayed away from the monitor, the more money I made, even on day trading. So we're still doing that. But I like 60-minute charts because you don't have to look at the market. Sometimes you know it's going to be at least 3 hours before you get a signal. And we went long here, went long there, went long there. Now, let's look at this point right here. This is an important point. Is where laser is up here, where it says long at 717, is that a fractal down right there? Somebody tell me why that is not a fractal down. Right, it needs one more higher low to the left of the bottom bar, right, to have a 5-finger. And when we first started doing this research, we called this the 5-fingered boogie. When I was in college, I worked most of my tuition playing in a Dixieland band. And one of the songs we played featured the piano player, and it was a 5-fingered boogie. So when we started looking at these fractals, that's the first thing we called it. So this is not a short signal here. So it came back down here. The market came way back down to here. But we're stopped, 2 fractals back. Here's the first fractal back. Here's the second fractal back. So our stop is way down here, which gives the market plenty of room to run. Then the market comes and makes a fractal here and makes a second fractal here. So when we went long at 711, our stop was way up here about a little above 690. And then the market goes up and comes down here, and then it makes another fractal there. At that point, our stop is moved to here. It comes up here. Why is that not a fractal down? Why didn't we go short at that point? Same reason, exactly. Didn't have the 5-finger. Now we have the 5-fingered here. So we were long 1, 2, 3, 4, 5, 6, 7 contracts. So we went on a 1-contract basis. And then we added to it at our stop here, by the way. That's 1 fractal up, that's 2 fractal up, it didn't get there. Then we come down here, and we have a fill here, 2 fractals back, our stop is moved to here. We have 2 fractals back, our stop's moved to here. And here we have a fractal up, so we stop and reverse and go long. We had 1, 2, 3, 4, 5, just over 5 weeks trading on a 1-contract per signal basis. We had 347 points minus 9 commissions. The maximum margin requirement we ever had was $4,800, a little over $4,800, but it's $50 a point, so that's about $17,000, which by my standards is okay. Let me, by the way, do you notice that various speakers, including myself, show you the graph of the worst day we've had? Doesn't happen very often. This is not, so we'll do the natural thing. We'll show you the best day we've had in day trading the S&P on a 1-contract basis, which was February the 4th of this year. February the 4th of this year, the market opened. This was where the market opened. Market opened basically unchanged, came up here and made a fractal up. Everywhere you see a caret, and this is on page 27, every place you see a caret is a fractal. Then it made a fractal down. Why didn't we go long here? Anybody tell me why we didn't go long? The leverage was gone, right? Remember, here is the start. There's the signal. The market came down below the start, which destroyed that signal. Everybody see that? Good. So it came up here, so we're still out, and then we have a fractal up here. Now, if the market had gone up at 10 o'clock, we would have bought there because our leverage goes back. The leverage always goes back to the first fractal in the opposite direction. But it didn't. It came down here. And notice that our first trade was over an hour and a half into the market. So the first hour and a half into on February the 4th this year, we weren't even in the market. We were still out. So we made our first trade. We went short at 485, which was our fill. And then it came down here. Our stop is, that's 1 fractal back, 2 fractals back. So our stop is way back here. Now, one of the things you'll hear a lot of times, and when the market's really moving in the S&P, your stop may be $2,000, $2,500 away. And people say, oh, my, I'm not going to take that kind of a stop. I never do that. Good money management is making sure that you put a $500 stop when you go into the S&P or the bonds or whatever. from our way of trading, that's really kind of stupid. It's stupid because you aren't trading the market, you're trading your wallet, aren't you? Or you're trading the bank. Remember what Einstein said, is the market a friendly place? Actually, he said, is the universe a friendly place? We transpose that to the market, is the market a friendly place? If you trade the market will take care of you. The market has no interest at all. It doesn't care whether you make $1 million today or go bankrupt. But if you follow the Holy Grail, which is simply want what the market wants, market's going to take care of you. Think about it for a moment. Every disappointment, every anxiety, every stomach crunch that you've had in the market has been for one reason. And that one reason is because your expectations went down. Whatever it is, the market did because the market's supposed to. The market's not supposed to do anything it doesn't do. So when we talk about this oversold and overbought, it's it. But saying to put a $500 stop no matter what is good money management is crazy from our standpoint, because you're not trading the market. What we want to do is get in on the market. We want to be like, if the market is the dog, we want to be the dog's tail. And when the dog runs under the hedges or wherever it goes, we want to go right behind it there. We've tried being the dog's nose, which is what Tom DeMark wants to be, but we haven't been successful in being the dog's nose. We get into a lot of trouble when we try to tell the dog what to do. So we come down here. At this point, our two fractals backs up here. We come down here, we have another fractal. We have a fractal up here, but the market didn't take that fractal out and didn't take that fractal out. Took that one out here, took that one out here. So now we're short a second contract and a third contract here. The market comes up to here. Notice where our stop is at this point. 1, 2 fractals back. Notice how close that is, but it didn't get us. And then we'll continue on the next page, which is page 28, on the same thing. And we're going in, and where we left off was at 12 o'clock. And so it comes up here, and here's 2 fractals back. We come up here. Look at this. We have 2 fractals up, but it never makes it there, but it gives us this fractal down, which gave us our 4th one short. We go into another congestion period, and then we come down into here, and this is now 2 o'clock Chicago. We have about an hour and 15 minutes left, and on that last move, I normally do not initiate a trade in the last hour of trading the S&P, but we were so far ahead of then, I just said, the bandwagon's going, let's get on board, and we went short our last one. And our last one we went short at about just about an hour before the market closed. And then what happened as the market closed, it came down here, we went short here, and this was our last one that we went short on the other one. And we had a bracketed market here, we had a sell stop here, a buy stop there. We exited MOC. This was the results of that day of trading. And this is really minus 1, 2, 3, 4, 5, 6, 7, 8. It's not 11. But that, by my standard, is a good day. It certainly was the best day we had on a one-contract basis in trading. Now, question was, say again? How are you getting your orders in? The question is how you get your orders in time. There's absolutely no problem, because you're trading a 5-minute chart, and you will know, it takes 2 5-minute charts to make an up move, so you have a minimum of 10 minutes to get your order in. So I rarely ever put in a market order. Are you putting the stops in? It depends. If the question is, are we putting our stops in, canceling, putting them in? Absolutely. And if you're a broker who doesn't do that, I know that there's some brokers who are now charging for cancel replace. You need to get another broker. Absolutely, right off the bat, fire him right on the spot. You can cancel, replace any number of times. That's their job to do that for you. You're hiring them. They're not your boss. Don't be intimidated by them. Get you a good broker and stick with them. Question over here. Yes? Stop orders. The question is, are we going limit or stop? We're going stop. On the entry. Yeah. And stop on the exit also. Exactly. Okay. The most trending markets in the world are what? According to Bruce Babcock's research, the most trending markets in the world are currencies. Over the years, we've probably made more more money in currencies than anything else. Fractal, again, is very simple. On a line drawing, this is what a fractal is. That's an up fractal. That means you want to buy above that. That's a down fractal. It means you want to sell below that. That's the only two fractals you have. So to make an Elliott wave, for example, if we label this an A and if we label that a B, if you put an A plus A plus A, what do you get? You get an impulse wave, like that. If you put a B plus A, what you get is a reaction wave like that. So the Elliott wave is actually very, very simple. And one of the ways to measure an Elliott wave is through the use of the MFI. And when I first studied the Elliott wave, one of the things that really bothered me was and I got interested in the Elliott wave long before Bob Prechter wrote his book. And I think Bob's book is very good. I think it's very difficult to trade from that book. It's a good explanation of what Elliott wave is, but how to trade it in the market is more difficult. The problem that bothered me was you always see an Elliott wave that goes like that, right? That's what you see in the book. You never, never, never see that in the market. You'll never find an Elliott wave that looks like that in the market, and there are reasons why. But the thing that bothered me was the Elliott wave is measured on a price line, which is not the Elliott wave, is it? So if you have an Elliott wave, let's say that's 2 bars wide and 2 units wide and 2 units high, that's a 2. They label that as 2, not number 2, but 2 in units. If you have an Elliott wave that's 10 bars wide and 2 bars high, that's labeled the same thing. And the one thing you can be sure of is this and this are not the same market. And so you measure the distance for wave 2 here, the distance for wave 3 here, the distance for wave 4 there, and the distance for wave 5 there. Now, I noticed that those are right triangles. And way back in 1981, I started calculating with a handheld calculator. This kept me off the street a lot. This was good for my character. That if you take the area under wave 1, which is combining the number of bars and the price difference, and you add to that the area of wave 2, guess what you get? You get the area of wave 3. If you subtract from that the area of wave 4, you get the area of wave 5, or a 62% retracement of that number. Now, this was back in the early days, long before Bill had the easy language, and I hired a computer programmer by the name of Bob King to program this for me and put it in the computer. And what it would do is I would put the price at the beginning of wave 1 and at the end of wave 1 and how many 60-minute charts or how many 60-minute bars it took, and it would give me 3 sections. And our Elliott wave trading started off with a bang at that point. We started making money with Elliott wave. Now, what we found in the Elliott wave using the MFI is we took the average MFI for every bar in wave 1. Took all the MFIs, added them up, divided by the number of bars, and we got a figure here, which we put on a graph. Then we got the MFI for wave 3, and we put it on the graph, and we came up with this, and the MFI for wave 5, and came up with that. About this time, I met a guy by the name of Tom Joseph, who I think should be in the Traders Hall of Fame. Tom was working on a computer program to count the Elliott wave. Now, the basic thing in the Elliott wave program is what we were talking about. It's calculated using the areas under the wave. And he came up with an oscillator to measure momentum, which is not an oscillator like the RSI or stochastics. RSI and stochastics are comparing price with price. What we want to compare is momentum with momentum, which is a very, very different thing. So Tom came up with the idea of using an oscillator where you would subtract a 35-bar moving average from a 5-bar moving average. Now, we changed that a little bit, and the reason we changed it was for good religious reasons, because 34 is a Fibonacci number, and we did not want to anger the voodoo gods. So we changed it to a 534. And then what we did is we added a trade average of that difference to make it an MACD. So we had a 534.5 MACD. And I'm going to show you that in a moment. And if you're going to trade, this MACD is basically the only indicator you really ever need. This thing should be worth literally or even 7 figures to you. It does 4 things. Now, what this does is the 534 oscillator, it takes a 34-bar moving average and subtracts it from a 5-bar moving average. So what a 5-bar average would follow the price line very closely. A 34-bar moving average would follow it more slowly. So what you get is a moving average of the MFI. So you get an online measure of the MFI. Now let's look at some charts. Now this is, let me find what page this is on yours. Turn, if you would, these things are hard to see up here. Well, you have a page in your book that looks like that. .46, thank you. Okay, turn over to page 46. This is the Profitability MACD, and MACD simply stands for Moving Average Convergent Divergence. And there is four things you can learn from this that this will tell you that is absolutely the most infallible indicator I have seen in 35 years of active trading. And I say infallible in capital letters. In the last year and a half, I have only found one instant on any bar chart where it was wrong in the least, and that was on a 30-minute bar chart in sugar last year. Every other time, it has been infallible. Now, there are four things it will tell you, but let me give you the instructions that are crucial. And the reason this is crucial is because a standard deviation, well, the biggest lag we have is 34 bars, right? 3 standard deviations is 105 bars. So the Elliott wave that you are analyzing, and this will take the ambiguity out of the Elliott waves, one of the things we guarantee in the tutorial is that by the second day of the tutorial, we absolutely guarantee that you can count the Elliott waves better than the guys in Gainesville, Georgia do it. If not, we'll refund all your money, all your tuition. And this is not the page that we're looking for. There's another page here. Ha-ha. It's the page before that. It's page 45. This is page 46. Give me just a moment here because this is important. Dum, da-dum. Here we go. Okay, now we're rolling. The crucial thing that you must have is that you must have a minimum of 100 bars in the wave count that you're analyzing. Not that's on the screen, but it's in the wave count. Now, if you use Bill's work, you can make more or less bars on this particular chart here has 140 bars on it. And what we're analyzing is the bonds, and these are the bonds this year. And here we have the bond move up. We have what looks like a 5-wave move up, but we only have 65 bars. Now, there's 140 bars on the chart, but the way that we're analyzing is that 5-wave move there, and it only has 65 bars. So if it only has 65 bars, and you have to have a minimum of 100 bars, what would you do? This is a 60-minute chart. Right, you go to a 30-minute chart, exactly. So if you go to a 30-minute chart, now we're seeing something that's basically infallible. Not only is it infallible, not a lagging indicator, it is a leading indicator. Now, the four things that it will tell you, let me push this up a little bit. The four things that it will tell you, number one, it will always, always, always tell you the peak of wave 3. Now, if we go back to the previous page, we'll see that the oscillator does indeed peak at wave 3 here, doesn't it? And then it comes down here to 0. Now, notice this page. And that's page 45. And then look at the next page, which is page 46, and notice the difference in that peak of wave 3. And if you can see the difference between that, then you will know you will eliminate over 85% of all the errors that all Elliott. And you know the old saying, you can take 2 Elliotticians, put them in a room with one, come out with 9 different counts.